Why is everybody freaking out about the bond market, and what even is a bond? Well, I'm Vivian, your HBFF and your favorite Wall Street girly who's teaching you all the finance and economics you should have gotten in school, and here's why the bond market might be a canary in the coal mine. Bonds, simply put, are just debt. You become the bank and you can essentially lend money to companies, local governments, and even the US government. And they essentially write you an IOU, pay you interest through the duration of the loan, and at the end, you get your initial money back. Bonds are typically seen as safer investments than equities because they provide a predictable income, they're less volatile, and debt takes priority over equity during a bankruptcy. And certain bonds, like US Treasuries, are backed by the government, so they were considered to be virtually risk-free from default. Or at least that used to be the case. Ever since Liberation Day, we've seen a ton of volatility in the stock market, and typically that would mean investors would flee to bonds as a safe haven. But instead, this go around, we're seeing investors sell off US government bonds, signaling a potential loss of trust in the US as a safe financial investment. And what happens when there's a bunch of bond selling? Bond prices go down. And the key thing with bonds is that price and yield have an inverse relationship. As bond prices go down, yields go up. Yields are how much you'd earn in 1 year for loaning your money or holding that bond. Higher yields makes borrowing more expensive for businesses and governments and consequently consumers too, increasing the cost of mortgages, credit cards, or other loans. Ultimately, these issues, coupled with rising inflation, potential rising unemployment, are leading to one big scary word: stagflation. And if you want to hear me break that down, follow and I'll cover it in my next video.